Dividend investors, bonjour, this is Mike Leroux, founder of Dividend Stocks and passionate investor. Welcome to this Dividend Uncut report. Today I'm talking about my own personal pension plan portfolio. Back in 2017, I quit my job as a private banker. I received the complete value of my pension plan and decided to invest it all in dividend growth stocks. Every month I publish the income report on my blog, and I'm trying to keep up with the video. So this time we're doing something a little bit different. I am offering you a complete presentation on my holdings and the results, and I thought it would be easier so you can see all the numbers. So today I want to start with telling you that the first quarter of 2020 means absolutely nothing in a lifetime. I started invested back in 2003. It's been more than 60 quarters that I am investing. So one quarter is about 1.5% of my current investor lifetime. And considering that I have at least 30 years in front of me to invest, what just happened in the past 3 months doesn't mean much. Just to show you what's happening here, I started investing in 2017 in September. I received a check. It took me about 3 months to be fully invested. Nonetheless, I compare my portfolio returns to two benchmarks. So the first one is a mix of both indexes, so we're talking about the TSX 60 and the S&P 500, and the second benchmark is two dividend ETF. So basically I wanted to see the difference between my portfolio, the index, or investing in dividend ETFs to see which one would outperform the other. The results are currency neutral because obviously right now the US dollar worth a lot more than it used to back in 2017, so it helps a little bit in my portfolio short term right now. As you can see right here, I've made the calculation pretty simple, pretty transparent. So the first one is the index. So market index did between September 2017 and April 6 before the rally, so April 6 at 7 in the morning. The return is 1.36%. Mine is 16.4, so I crushed the market by 15%. So how about if I had selected dividend ETF instead? Well, pretty much, it's almost the same thing, different results from both sides of the country, but in the end, 1.6% return, so I beat the index once again by 15%. I am not showing you that to brag or tell you that I'm a great investor, that I'm the next Warren Buffett or all those things. Actually, it's not the point. The point here is quite simple. I follow a strict methodology about dividend growth investing. I focus on dividend growth stocks, and I never ever get away from my plan, and this is why I am successful right now. This is why my portfolio, even before this week's rally, is doing well. So here are a few pointers if you're looking to manage your portfolio as I did. The first one is not to be overexposed to a single sector. I know a lot of fellow Canadians love Canadian banks or love the energy sector, and they have like 30, 40, 50% of their portfolio invested in those sectors. Well, the thing is, even for Canadian banks, they have outperformed the market for decades now. The thing is, if they get hit, your entire portfolio is at risk. I don't want that. I don't want to get hit by a specific sector in my portfolio, and for that reason I try to get everything under 20% for each sector. I'm going to show you my sector allocation in a minute. You'll see that some of them are a little bit higher, but I'm willing to take those risks, and I'll explain why. But in general, if you go over 20-25% in a specific sector, you're taking more risks then you're going to get rewards from it. The second thing I've done is to invest based on the strong dividend triangle. I've done videos about that in the past. I've written about the dividend triangle in the past, but basically this is the first stock screen that I'm looking at before going deeper into my analysis. The first thing I'm looking at is revenue growth, earning growth, and dividend growth. So basically, I'm looking for companies that are leaders in their market, that have strong growth vectors, so they are able to grow their revenue, make more money with it, and obviously share the wealth, increase their dividend payment. Looking more at trends 3, 5, 10 years than looking at specific numbers, but this will tell me in the blink of an eye if the company is doing well or not. Keep in mind that over the past 10 years, before this crisis, economy was booming, unemployment was low, consumer confidence was super high, people were spending, they were going on vacation, debt was cheap, there was an appetite for debt and for projects. So if a company cannot thrive in this kind of situation when the environment is almost perfect, how do you think it will go well in the current recession? It's not, right? So this is why I focus on those metrics. Then I've also used 5 to 10% of my portfolio to make riskier plays, sometimes on the economy, on trends. A few examples would be buying Qualcomm in the middle of their legal crisis against Apple, buying Canopy Growth to drive a rare non-dividend paying play actually on my portfolio. Sold it during the with a stop sell, so I've made a lot of money from this one. Buying Shopify for the same reason. It was short sell by hedge funds. I thought, you know what, the business is doing well, let's grab a few shares and then get rid of it when I make profit. But those are only 5 to 10% of my portfolio. The rest of it is invested in core dividend growth payers. Never consider the yield. A lot of investors are telling me, Mike, you're calling yourself the dividend guy, but your portfolio's yield is about 2.5, 3%. It's nothing. It's not even enough to live off your dividend. That doesn't make sense. You should be called the total return guy or anything else, but not the dividend guy. Well, I think that while I base my decision on dividend growth potential, I don't think the yield matters. You'll see my portfolio in a minute. I have most of my best performing stocks right now are actually low dividend payer, low yield stocks. Even though the yield is low, right now they're still increasing their payments and the stock value is high. A lot of high yielding stocks saw the complete opposite. Not only the stock price was crossed by 50, 60, 70%, but the dividend was cut. So basically you're losing on revenue and you're losing on capital. You're not getting any better just because you focus on yield. I don't think it's a good strategy. Consider dividend growth potential instead. Finally, keep your winners. I have very good picks in my portfolio that have outperformed the market by a wide margin. Those companies, I will likely never sell them. The idea is quite simple. I look back each quarter, look at all my companies, and revise my investment thesis. The investment thesis is the reason why I think this company should outperform the market over the long term. If those reasons are still good today, I'm keeping my shares, even though my investment is up 100 or 150% or 200% or even 400% like Apple in my RRSP portfolio. I'm going to keep those shares because the investment thesis is still valid. And this will obviously compensate for when I'm making mistakes and when I have companies that are hurting my portfolio returns and that my investment thesis was wrong. Well, if I had like strong players there that keep running, then I'll be able to have a good average performance. Oops, sorry. So sector allocation, as you can see, 74% of my money is invested in 3 sectors, which are technology, financial services, and consumer cyclical. Within those sectors, I make sure that I am well diversified across various industries. The best example is financial services. I have banks, asset manager, and I have Visa, which is not affected by what's happening with banks or asset managers because it's half a tech stock, half a payment network company. So basically, a lot of people right now don't want to have cash. They want to pay with cards, so it's still a good thing. There's a movement of going digital as well. Visa is the most trusted, the strongest player in the payment network across the world. Well-diversified play here versus banks or asset manager. In the consumer cyclical, it's pretty much the same thing. I have companies like Starbucks, Disney, Gentex and Magna International, Intertape Polymer, all those companies are evolving into different industries, so ones are getting hit more than others, and it helps me to have a better diversification. Then you have tech stocks that right now is my largest sector, and we have like great companies like Microsoft, Apple, and Texas Instrument into this one. Those are my Canadian companies. One of my favorite right now is Alimentation Couche-Tard, very safe play here. I decided to keep CAE even though they suspended their dividend. It's only normal right now. They're not making much money because civil aviation training is not very popular these days. But you know what? One day the economy will resume, people will take flights again, and the business will be booming. It was doing incredibly well before that happened. Flight simulators are a necessity. Flight training is a necessity, it's mandatory, so the business will not die because of this crisis. Obviously, right now it doesn't look good. Another good example is Intertape Polymer. It was priced not too long ago for a dividend cut. The business was not looking well on the stock market. And then the CEO came yesterday and announced in their press release COVID-19 update saying that half of their business is related to food packaging and e-commerce. You may think that those are sectors that are thriving right now, right? So while the rest of their business is slowing down, this part of the business is thriving, and the CEO said, you know what, because of that, we're just making business differently right now, but our 2020 guidance, the financials updates are still remain the same. We don't expect any slowdown in the business because food packaging and e-commerce is just supporting the entire business by itself. Having precision, clearing out the uncertainty, made the stock jump by 20% yesterday. Not because it was an incredible announcement, but because the market thought, Intertape Polymer is growing through acquisition, they have debts, they will go down and die. Well, CEO said, well, you know what, we're making money as we used to and everything is fine, so you might want to reconsider your investment thesis. In the upcoming months, you will get those updates on the COVID-19 for many businesses. You will have the chance to read in the quarterly earnings how the virus is affecting the specific business. It will tell you a lot more information, and this is when you can trade and make great decision here. Now you have my US portfolio. Great winners such as Apple, Microsoft, and Visa are obviously helping me going throughout the storm. I have other companies that I may expect a dividend cut. Disney is one of them. I really like Disney, but right now they have more than 50% of their revenue going just closed because cruise lines and theme parks and ESPNs cannot make much money these days. So expect a terrible quarter, a terrible year for Disney. But on the other side, they have been developing Disney Plus. Their objective was to reach 60 million subscribers by 2024. So in 4 years from now. And now, a few months after they launched the service, quarantine obliged, they are now at 50 million subscribers. So while half of their business is on pause, not because not doing well, it's on pause. They cannot run their business right now. They are developing another income stream. So what's going to happen in 2-3 years down the road when the economy booms again? Well, Disney will just thrive with one more income stream in their business model. They're just going to make a lot more money, and this is one of the company that will thrive in the future. Obviously, short-term perspective are terrible, but right now it's already priced. The stock is already down big time, so I'm not too worried about it. Now, going to my dividend. What you see here, I made almost $600 in dividend this month. It's an increase of 1.1% compared to last year, but this is due to a timing in dividend received. If you look here at the month of February, the green bar is quite lower than the purple one because in 2019, I did not receive Lazard's dividend payment and special dividend in February. I received it right there in March. So when you go back here, this year in 2020. I receive it right there in February. So this month does not include Lazard's dividend payment, and yet I still made more money. This is to show you how over time, when most of the companies are increasing their dividend, I've added a few new companies like VF Corporation and Sylogis that were not there in 2019 in my portfolio. They're there right now and they pay dividend this time. So overall, I can see that I'm making a lot more money month after month, and the next chart will tell you that even in a more obvious way. Those are the total dividend I've received so far. So we're now at $8,052.63 in Canadian money. Every month I'm receiving more money, and this graph keeps going up. It's a lot funnier and a lot more interesting to look at this graph than looking at what's happening on the stock market right now. I expect that March and then April and then the next month will be better than that, just because I'm just receiving more money all the time. I hope that you have enjoyed this video. I hope that it calmed you down. Right now we're having somewhat of a good week, right? There's a good rally happening, but I expect more volatility. I expect more market drops in the next 2 months. It wouldn't be surprising. It will all depend on the data on the virus that we get, if it's under control or not, or economic data. So as we get more information, the market will calm down, but expect more volatility in the next 2 months. It will not be easy, but in the meantime, I think that you should stay invested and stick to your plan. When you have a strong investing plan, it works. It has been working for me for the past few years, and it will still work in the future as well. Don't forget to subscribe to my YouTube channel to get my video updates. I do 2-3 videos per week now. If you have any questions about my portfolio and how I manage my stocks, now is the time to hit the comment section. Tell me how you're doing. Tell me what are your questions about my portfolio, and I'll make sure that I answer them in futures video. All right, guys, so stay invested and we'll talk soon. Cheers.